Good afternoon, everyone. I'm Pradeep Tagare with Intel Capital. For those of you who don't know, Intel Capital is a venture capital arm of Intel Corp. We are a technology investor globally and in India as well. So before the panelists introduce themselves, I just wanted to start off by saying, this topic is one of the taboo topics in the industry. It's the first time that I've seen a conference actually put this as a topic for a panel to talk about. Failures in the industry. How many stories do we read of companies shutting down or not doing well or having issues and all of that compared to what you read in the ET and other publications every day on companies raising hundreds of millions of dollars and doing so well and India being on the map and all the hoopla that goes with it. The reality is that for every one of those, there's probably 10, 20 companies that really, really struggle. And they struggle for a variety of reasons. So the intent of this panel was to kind of dig a little deeper into what those struggles are, where we as investors that have done multiple deals, where we see common mistakes that entrepreneurs do, how you can possibly avoid those mistakes, and then get into discussion on different aspects of that. So we thought we would break this into different areas in the life cycle of a startup, starting with funding. What are the common mistakes that we see there? Talk about hiring, talk about scaling your business, talk about strategy and strategic mistakes that companies make. And finally, we also want to talk about mistakes that we as investors make that hurt entrepreneurs. Most of us don't, but we'll talk about others that do. So with that, let me turn it over. If you guys can just introduce yourself and your firm and your recent investments, then we'll take it from there.
I can start. As Pradeep said, it's not an easy topic, but I think it's an important topic to discuss. Let me quickly give you my own background. So I run a venture capital fund. We raised 250 crores in a first fund, and which is almost fully deployed now. We are now raising a second fund, which is 900 crores. And we typically invest in Series A, Series B companies. We are looking for Series A, Series B funding. And so far, we have invested in 8 companies. And what is different about us is we actually operate through a different model. Basically, we have the IIT Alumni Trust as our anchor investor, where we have a very large number of IIT alumni around the world who have invested through this trust. We try to address some of the key issues that typically startup companies face, like what Pradeep talked about, the challenges of recruiting, issues of talent, and lots of other issues that typically companies face at early stage. We address that by bringing a very large pool of talent across the world, primarily through the IIT Alumni Network, which works very closely with us through the campuses of IITs, because we have deans of IITs on the board of this Alumni Trust. So that's the model we follow. I'll let the others introduce themselves, and then we'll get into the topic.
Thanks. I'm Karthik, one of the co-founders of Blume Ventures. We've been around for about 4 years, raised a little over 100 crores in our first fund. We're mostly a seed, early stage seed angel kind of fund, pre-Series A. We're obviously fairly prolific for those who know of us, 65, 70 investments. And basically on the verge of our second fund, so we hopefully will be back in action in maybe 4 to 5 months. We're in a fundraise trip right now. It's not easier than startups to raise our money either. So happy to be on the panel and looking forward to the conversation.
Hi, my name is Vikram. I'm with Matrix Partners. We're a venture capital firm which focuses primarily on Series A investments of $2 to $5 million. We selectively do seed, and we also selectively do Series B investments between $10 and $15 million. I've primarily focused on mobile and mobile internet. And as a firm, we do consumer internet, mobile, SaaS, and SME tech. Happy to be here. Hopefully share some mistakes that we've made, which should be helpful for all of you.
All right, thanks a lot. So before we start, just a couple points. One is you have 2 early stage investors here, and I would say 2 early plus growth stage investors. So hopefully we can cover the life cycle of a startup. We are going to do this by the sections that I mentioned. So we are going to open the floor during any section. If you have questions around funding, just ask them at that point instead of waiting till the end. And finally, we are going to be very open and honest about what we have seen, the mistakes that have been made. This is in no way intended to ridicule the entrepreneurs or the companies. You know, every company goes through their own particular situation, and so we are not judging anyone. We are just trying to use that experience to hopefully give some information that will be of use to the audience here. All right, with that, let's start with probably one of the most important parts in a startup's life cycle, which is funding. Let's start with you, Vikram. So early stage, you know, couple guys, 3 people with a business plan, lot of enthusiasm. They come to you, they want to raise money. What would you say are the 2 or 3 things that you have seen that they do wrong?
So I think, you know, typically at very early stage, one of the issues that most of the entrepreneurs face, or the challenge they face, is they typically don't know who to go to. So, you know, they're really struggling to find an investor. And if they don't have mentors or somebody guiding them who's really someone who has a lot of experience, then the challenge is even more. So I think the first challenge that they face is who to really go to and how to present themselves. The second issue is, even if they find somebody, because of lack of experience, they really are not able to really decide whether they're talking to the right person. Because, you know, the issue is that, you know, they are looking for funding, they're looking for just taking their business off to a point where, you know, they can start really growing fast. But, you know, they do not necessarily pick the right people early on, or they don't necessarily also have the patience to really go around and meet with large number of people and then decide who do they really want to work with. And I think that's an issue which I have seen very common with most of the early stage companies, you know, not being able to pick the right partner. The third is, you know, in fact, this is something which I have seen, again, very common, is many times they don't know how much funding to ask for. So what happens is that, in fact, I'll just give you an example where this one guy I was talking to, I really like the team, I like the business model, overall the industry sector they were playing in. So I said, you know, so how much funding are you looking for? So he said, I have a 5 crore plan and I have a, you know, $5 million plan. Which one do you want? So I guess, you know, it's like they themselves don't know, you know, I mean, what is it that, so if they really know themselves that, you know, it's the 5 crore which is more important to them, or 25 crore which is more important to them, then they will be able to handpick, you know, these are the people who will really, the ones they should go to. So I think these are some of the areas which I would say are typical challenges that I've noticed. Of course, there are many, you know, related to the business and other things, but from a funding perspective, I think these are the ones to highlight.
Karthik?
So I think, no, Vikram summarized most of the points well. The only thing I would add is that I think most founders get caught up in how to think about valuations and obsess around, you know, there is always, I think, especially in a market like India, which has not seen enough success and cash back to investors, you're not going to get fancy things like convertible notes at discounts, etc. You know, a lot of people walk up and say, we want to do a convert note. So I think if you have an international set of investors, you will get potentially somebody who's willing to take that risk. In India, nobody will. The angels won't, seed funds won't, VC funds who do seed rounds won't. So in some sense, you're obsessing about things which don't matter until you even make it to the next round. So the first step of the journey is, can you even show that the business model can be built to the next round? And you're worrying about a little too much about certain aspects, in my view. So we see this as a consistent problem, right? And what we've noticed is, or what you should notice is, if all the startups that you read about in the Economic Times and VC Circle are companies who have scaled to $200, $300, $400, $500 million or $2, $3 billion. The founders own very little of those companies. It doesn't matter. I mean, in the sense that these are rounding off errors when you actually build a great company in a short time frame. So what I think most entrepreneurs miss out is when they're coming and signing up for a venture funded journey, there are certain rules of engagement around that. If you're not prepared for that, you shouldn't waste your time with venture capital per se. You should bootstrap and build it in your own way. So if that creates a lot of friction, I think, not just, so I might pass on it and say, okay, here's 2 crores, let's agree on 10 crore valuations and move on. But I don't think it pays well because that mindset never leaves the entrepreneur. So we need to correct it early on and say, are you ready for this journey for 8, 10 years? Otherwise, let's not do it. The one other point I would add is, I think, typically the way to think about capital raise is, will it at least last 18 to 24 months, if not 30 months? In Indian context, I think it takes that long to make a business problem come alive, the business model come alive. And if you go with a half-ass business model, you don't get Series A funding. And so it's a much longer journey, and you need to bulk up on capital if you can. And then that goes to the choices of the investors you find, things like that. You can't go to, a set of investors who can't give you that money, and you're starting off on the wrong footing.
Okay, so before I come to you, let me ask you, Vikram talked about finding the right investor.
Yeah.
How does an entrepreneur go about finding the right investor? What does that even mean? I mean, money is money, right?
Finding the right investor is easy. You just Google Matrix Partners. And that's it. So I think it's a hard question, and I think it really depends on who you are. So I was going to chat about that, and okay, if you mind, I'm going to give a slightly roundabout answer to that question. So one of the things that's easy to get into the trap of is to get a large number of people who have very famous names to start investing in your company very early. And some of them can be very, very useful and very powerful for your own brand. But frequently, if you end up, for instance, doing what is called a party round, where everyone is just coming in for the party and investing some money, people are not really invested in you, right? And I think finding the right investor is to find someone who's really invested in you and invested in your success. And honestly, that can be anyone. Right? It doesn't need to be an institutional investor. It can be anyone who believes in your growth and is contributing to your own personal growth as a founder and entrepreneur. If you find that chemistry with someone, I would say it's better off having that one person as an investor as opposed to having 5 people who have famous names. I think that's what I would look for.
From a growth point of view, other issues that you can think of?
Sure. So I think the focus frequently tends to be on valuation, money raised, more so than anything else. And there's not enough of a conversation around long-term vision and long-term commitment. Right? So for instance, if I'm investing in a company, for me it's very important that I actually talk through 5 or 6 different ways in which this company can change direction, actually. Because the truth is that your company is going to change direction. There is no chance the plan that you and I are discussing today is the plan 12 months from now. Something is going to change. And I think thinking through the fact that how you will think about some of that change and getting comfortable about that is actually more important at early stage, early growth stage, whatever stage you are, as opposed to just focusing on that valuation number at that point in time. As long as it's within a range, right? If someone is lowballing you, don't take their offer.
In fact, I will take it one extra step further, which is quite a few times the mistake that we have seen entrepreneurs make is actually go for a really high valuation. And that's counterintuitive to entrepreneurs because obviously higher valuation is better for you, less dilution, and so on. But what a lot of people don't realize that if you look at it over the life cycle of the company, getting a higher valuation and getting an investor in at a higher valuation is just increasing expectations from your company in a very short time frame. So if you're able to deliver, if the macro works in your favor, then great, all that works fine. More often than not, it doesn't quite work that way. So something goes wrong and you're not able to perform. And then the pain that follows in terms of either down rounds, in terms of pricing next rounds, or even being able to get next rounds because of the earlier round valuation can really, really hurt a company. So, our perspective is always find that fine line where you're not going for the highest valuation that you can possibly get, keeping in mind that that gives you enough wiggle room over the life cycle of a company. And as Karthik said, if you're thinking of this as a big company over the long period, then that difference in dilution doesn't really matter to you a whole lot. All right, that's great. Unless there are any other questions on valuation and financing that you want to ask the panel, let me move on.
We'll break the flow, we'll just take it later.
Okay, yeah. All right. Let's talk about hiring, the other interesting area of startup activity. What have you seen there?
So I think, especially in the early stage, there's always an issue of finding the right talent. So the problem is, unless you have it in the founding team, it becomes very difficult to go out in the market and get somebody to work with you. The good news, though, is that if you go to the campuses of IITs, IIMs these days, people are all about startups. So, people are no longer going abroad or looking for jobs in established companies. They're all looking for startup experience. So I think that's the good news. But at the same time, the issue that comes up, the most fundamental issue that comes up, and the question that I am asked most of the times is, I'm looking to hire this very smart guy who I believe can add a lot of value, but I don't know how to compensate him. Now, this person might be earning a salary somewhere, very good salary, and then, I want that person to take a salary cut. I want to give him, some ESOP in the company, and I don't know how to structure that. So I think these are some of the basic issues, in terms of how do you, first of all, attract the right people to come to you. And second is, if you've decided there's a match that, people are willing to work with you, really how to make sure that, they're aligned with the vision that you have as the founder, but at the same time, they're compensated properly and they are aligned with the overall growth of the business. So I think these are some of the basic issues. And some of the smart entrepreneurs have been able to really handle these issues very well, by finding the right ESOP pool up front, or creating an ESOP pool up front in such a way that, and able to show the vision so that people can actually see the value growing for them. But it's I would say the most fundamental issue in most of the early stage companies in terms of getting the right people. We, of course, at IvyCap Ventures, we try to solve that problem through a very large network of people we operate through. And in most of the cases, we have been able to fill the gaps. And also, we have a mentor model where we have a very large pool of people who actually work as mentors, who fill the role, partially, for example, if somebody is looking for only sales function in a particular geography, you can't really afford a person early on. So we'd look for somebody in that network who's actually based out of a particular geography, and can that person make some introduction? So things like those try to help the problem.
So Karthik, you have 60 companies in your portfolio. Coming back to the ESOPs and structuring of compensation, have you seen any disasters? Companies that kind of blow up because they didn't quite structure it right?
I don't think it's a structuring issue that early. I mean, there isn't sort of too much money or too much value that fights or cultural issues are emerging around that as yet. So I think it's more around, so for us, single founders are becoming very difficult to fund. There's just too many challenges in this country to build a company fast enough if you haven't decentralized and built a team around yourself. So we're not saying everybody has to have equal shares, but you have to build a team which like Vikram pointed out, and everyone on this panel probably knows now, it's becoming all about the team, the strength of the founding team, and how quickly you can assemble that team as opposed to how later you can assemble that team. So it plays into Series A perceptions, it plays into valuations, it plays into your ability to grow when the capital is actually there, right? And so you can argue that once I get $3-4 million in the bank, I can go and do all of this. It's not trivial at all. Because at that point, you're hiring employees, you're not employing co-founders, right? Or you essentially want people who believe in the vision before they see the fat paycheck in the bank. And automatically, such people are more encouraged by ESOPs and shares as opposed to, I need 48 lakhs or 36 lakhs as opposed to 12 lakhs, 18 lakhs. So I think we've too many cases. In fact, I would say we've had half a dozen cases of co-founder splits, right? So that to me is a little worrisome from how we probably picked them. We probably paid too much emphasis on one of the co-founders coming and pitching to us without necessarily seeing what the rest of the team believes in or how they respect him or not. So I think there are cultural issues in not having a great founding team, which are very difficult to rectify post-fact. So coincidentally, we are at an offsite tomorrow, day after, primarily obsessing about the learnings from these 60 companies. So if this was next week, I would have just had a long list of these things.
So I think for me, hiring is a lot about initially who do you hire and what do you hire for. And one mistake that we try to keep our founders from making is founders frequently hire below themselves in certain functions and skill sets. I think it's very important early on to hire above you, which is if in tech and you're making a tech hire, if the person there is not better than you at something, don't hire them initially. If the person is not better than you at product, then don't hire them for product. They should be much better than you, right? And you're the founder. They can be VP, president, whatever they want to be, right? But there are going to be only a few founders, right? So I think most important is to just hire above you, have the confidence that it will work, and don't look at people who are more junior, who will listen to you, and so on, right? That's I think the one most important thing. And while you're doing that, I think it's important to figure out what your DNA is and match for that DNA. So for example, you're someone who actually respects very high IQ and you've gone to pedigreed organizations and you like that DNA, right? So it's hire from that DNA. It just sets up that person better for success because you enjoy easier chemistry upfront. On the other hand, we want people who are affable, like people skills, or are very hard charging commercial guys, right? Figure out that is the DNA that you like and hire that DNA. I think it's more important to hire for that DNA as opposed to, again, hiring a brand name CV, because that DNA will be more successful with you.
I'll give you a couple examples from our portfolio where these issues really made a difference. One is founders and how equity is split between founders. Typically, you have 3-4 people that come together, and one person maybe gets a higher ratio than the others. But then, so maybe it's something like 40% to one, 20% to the other 3, and they start this whole thing. When the reality is that all of them are not equal, right? But just because they have come together, they sort of feel it's the right thing to do. So in this particular company, that's how it was set up. One of the founders left after 4 years. He was fully vested, owned 20%, originally 20%. He was diluted down. 8 years later, they got an offer from a large MNC for about 150 million. And the CEO at that point said, there's no way the guy that has left is making the same money as the rest of us. And essentially that deal got killed because of his ego around it and because of the bad blood between the founders. So it's very, very important when you're structuring it up front, make sure you know who is contributing what to the company, and that gets carried forward.
But that's very hard to do up front, right?
Yeah, but at least have some sort of at least understand whether everyone is bringing in equal value to the table as opposed to just everyone being at the table. right? And a lot of times entrepreneurs and founding teams are very hesitant to do that because they don't want to go through the process of saying, you are bringing more to the table than I am. It's just that because 4 of us came together, came up with an idea, so we are all equals. That's what we typically see, right? And the reality is that they're not all equals, right?
So
and that creates bad blood.
I'm using this as a learning opportunity myself. So does vesting work when you do something like that and use the VC to actually enforce the vesting? Does
Absolutely, yeah. So that's one of the...
So the learnings for us have been that, a lot of this behavior is obviously even more heightened in the early stages of the company, right? So somebody might decide to leave after 2 years. Technically, they're 50% vested. So we are taking it upon ourselves as our responsibility to try and mitigate the effect of that vesting and actually do sometimes engineered buybacks, pass some of the equity back to the founders. We have to do it because otherwise it will create this issue later on where for no effort thereafter, this is pre-Series A sometimes. And the guy is then owning 5% of a Series A company where you were not actually there for the tough part of the journey. So it's challenging, but I think mentally I'm beginning to think that we have to budget a little bit of money, put that cash on the table, whether it's 10, 15 lakhs, and move him out gracefully out of the cap table because he doesn't belong in that eventual outcome. And there is a risk. In one case, the company is blown up. So I've lost another 10 lakhs or whatever, right? In the other case, it has worked in our favor because both us and the founder clawed back some equity for that loss of that co-founder. So it's tricky, but we're trying to find a balance.
Yeah, and I think it also goes back to the point that you made earlier in terms of the overvaluation or, the other point to that is also, heavily undervaluing yourself. So I think you have to find a balance because when you overvalue yourself substantially, the issue with you is, raising the next rounds, there's always a challenge. On the other hand, if you actually dilute a lot early on, one of the issues is, what is the incentive left for the promoters? Because if they are, a very small stake in the company, so there, part of the way the people solve the problem is actually adding more incentives or, performance-based, earn-out. So I think those models work very well, and I think that's what you were trying to allude to.
So let me take that and jump directly to the investor section of this, looking at a time. So investors, obviously, it's a relationship between the investor and the entrepreneur. Things go wrong. Things always will go wrong. What are the things that you think as investors we are guilty of that hurt entrepreneurs? Again, we don't do it, but other investors.
I think one of the biggest mistakes that I have seen investors make while making investments is they tend to very emotionally connect with the business model of the promoters. And when they do that, what they're trying to do is impose their own vision on top of the promoter's vision. And that is when there's a potential of a clash. If you are investing in a business because you're seeing an opportunity on top of what the entrepreneur is seeing himself, chances are that you will try to push the entrepreneur in the direction that you want him to go to. While you may not necessarily have assessed that, he doesn't want to go to that direction. And that you might realize after making the investment. And that's when there's a clash and there's a lot of, fights, which leads to lots of issues. So I think this is one of the very fundamental issues I'm seeing, at the time of making investment. The investor tries to impose their own ideas and, which could be very different from what the entrepreneur is thinking. I think the other thing is that many times the entrepreneurs are either focused on, too focused on certain things, or they're trying to do too many things. And when you're too focused, the investor basically tries to create, other avenues for growth, and that's again different from what the entrepreneur might have in mind. When the entrepreneur is trying to do too many things, I think the issue is, how do you prioritize? And I think, again, the challenge is the investors who make mistake thinking that in a prioritization list, I think this is how the prioritization should happen, and this is how after investment I'll make them prioritize. I think things do not necessarily work. So I think there's some of the things which I have seen, how investors end up making mistakes.
Got it.
I think sometimes we've been, I think the other extreme of what Vikram said, which is being too lenient also and allowing the position, the entrepreneur to stray from what was the stated objective. So we've actually had I guess some of the worst experiences where businesses have pivoted despite us not agreeing on things or having multiple plans be run at the same time. And it's the nature of the market. I'm not saying there's a right and wrong in this, but we have now become very clear that a person who's a Series A investor and is risking $2, $3, $4 million, which is your natural next stage, doesn't like ambiguity in team, plan, direction when they're risking that kind of capital. In India, that money still adds up to a lot, right? At 15, 20, 30 crores is a lot of money. And you don't want to see that go to waste because you find confusion broadly when you enter. So at our stage, it's very important to spend the first 3, 4, 5, 6 months and then bring everything into sharp focus. I remember somebody on a similar panel around InMobi talked about disciplining yourself if you want to pivot. So you set a timeline on how much money is burnt and then make a call that this is about the time you either have to pivot or not. But don't keep extending that discussion till your last 3 months of bank reserves are there. Then you're screwed. You have to kill the company. So I think the other thing we've realized a lot is we've let founders linger in this steady state when you can see the writing on the wall. Everybody, and we're also a young fund, right? So we're afraid to call it out and say, let's do something about it, right? And then you go back next month and the situation is only worsened. So in India, I think what we've realized is even if it means giving away your assets for very cheap, find a sort of a home for that business. Either the founders go and get acqui-hired by somebody, they get merged with one of your companies, you sell the IP, but whatever is recoverable at death minus 6 months. It's not recoverable death minus 2 months. By then everybody's freaking out, right? People are checking out, some founders left, somebody else is giving up, there's not enough money in the bank, you're winding down, you're in indebtedness. So people are not thinking straight. So the big mistake we made was we would say, yeah, we'll see how long the money lasts. You have to start thinking 6 months before. So those, I think, were, at least in our failures, those were some of the big learnings.
Okay.
So I think two things similar to what Karthik said. One is just not having direct conversations early enough. I think it's very important when you start spotting something is not going according to plan, actually to just raise a flag and let's sit down and have a direct conversation on these are things that are going right, these are things that are going wrong. And I think that conversation is actually much better than being a nice guy sitting on the sidelines and then raising a red flag 6 months down. I think one of the ways in which it manifests itself is that at the end of the day, startups have finite time of the founders and finite capital, and both of which are running out at a very fast period of time. And at least the role as investors that we have to play is to optimize for both. And at any point of time, when you're seeing either time or capital, or in most cases both, going the wrong direction, that course correction is the most important. Right? And actually have an honest conversation on time. So one of the things that I use is a time chart, which I let founders draw for themselves on where do you think you should be spending time, and then look at their calendar on where is that time going. And very often, 80-20, it will be the other way. Right? And that's an immediate course correction that happens.
I think we are out of time. Maybe we can take it outside. All right. Thank you to all the panelists. Thank you, audience.
Thank you.